contracts, another a $280 commission, by the way. So he put on 2 contracts in Chicago. So I was long New York, short Chicago at this price. And he said, when the market goes back in your favor, we'll take the short leg off. Because the whole idea originally was to be long silver, okay? So we'll take the short leg off when the market goes back in your favor. So the market did, it went back in my favor, and he took these 2 short contracts off, but in essence locked in what, a $2,500 loss when he did, right? Okay? That was a realized loss. But then what happened is that the market went back down to 950, and he put the 2 back on. What? Now, what I'm about to show you is, in essence, the silver market went into about a 2-week trading range between 950 and 975. I didn't know what a trading range was. I didn't even see a chart, okay? And I would say that he probably didn't either. Go looking back in the situation, he didn't know what a trading range was either. But what he did do is that every time it went back to 975, he took the short leg off and locked in another $2,500 loss. It went back down again to 950. He put them back on, and it went back up to say put them on. So he did this over a 2-week period several times. And finally, it got to the point where I couldn't open up my brokerage statements, and I was in an extreme state of distress. And until I got to the point where I just woke up one morning and said, I can't take this anymore. And I went into my office and I called him up. I said, just get out of it. Just get out of everything right now. Oh, man. This is probably the reason why I'm here today, okay? I'm not kidding. In fact, it is. Because about, I'd say 20 minutes or half an hour after making this call to get out of everything, the market finally broke out. The market finally broke out of this trading range. Yeah, no, this isn't it. No, this is the worst part of it. The market finally broke out of this trading range, and of course, we never saw this price again because shortly thereafter, within a couple of weeks, you remember the Hunt Brothers debacle? Okay, I was in what you call the perfect trending market. It couldn't, when I say the perfect trending market, I mean it was absolutely, because what's a perfect trending market? One that virtually goes straight up, right? Okay, no retracements? Well, the market couldn't go straight up because the exchange imposed price limits. In other words, the exchange says that the price of anything can't deviate by more than, let's say in silver, I think it was 50 cents a day. I think it started out, it was 50 cents or $1 a day. I don't remember what it was. Anybody remember what silver, what the price limit was on silver? Tony, do you remember? Back in the early 80s or late 70s, what the price limit on exchange imposed price limit on silver was a day? Was it 50 cents or $1? It had to be $1. What?
I think it was $1.
Well, yeah, it started out at 50, but it went to $1.
Well, he had 3 limits in a row. Then he started.
Yeah. Okay. So you know what I mean by limit move? Everyone knows what I mean by limit move. Okay. In other words, when the price went to let's say 10.25, we started out at 9.75. We just started out at 9.75. If the price went to 10.25, that's a 50-cent move, and the exchange says, okay, we're not going to execute any more buy orders. It doesn't matter unless there's enough sell orders. Unless there's sell orders, of course, to take the other side. But if there aren't enough sell orders, we're not going to execute. In other words, we're not going to let the price go any further than 10.25 today. Okay? Now we don't know what's going to happen tomorrow morning when the market opens. But in this case, instead of having a bar chart that looked like this, because a bar chart would imply that there were trades within those bars. The silver market, in our charts, the silver market looked like this. They were dots. This would be a day, this would be a day, this would be a day, this would be a day. They were dots because there were no trades. Because there wasn't anybody willing to take the other side of these buy orders. In other words, we had a flood of buy orders into the market without any inventory to take the sell side. So the exchange had to move it up the limit for the next day, and then there weren't any sell orders, limit up again. This would be a perfect trending market because you don't have to deal with retracements. Okay? And then it went all the way up to $49 an ounce. Basically, I was like that close to, in my mind anyway. I'd have never hung out to 49, but at least at the time, I was like that close to what I thought was $400,000 on a 2-lot.
And it didn't take long.
And no, it took 30 days or so, a little over 30 days. Now, the reason why this happened is because the Hunt brothers, who were Texas oil millionaires or billionaires or whatever, they got the idea that they were going to corner the silver market. And the way you corner a market is, one, you start buying up as much cash silver as you can, You start accumulating a huge inventory of cash silver bars, whatever, okay? And then what they did is they went into the futures market and bought as many futures contracts as the exchange imposed limits would allow them to. However, that was quite a few futures contracts. But see, what they did, and the reason why they ended up taking a huge hit on this whole deal is because the exchange said that what they did is they bought more than the limit through other entities that they said they had no relationship with, but the reality is they did. So here's the deal. Here's how a market gets cornered. Is that if there's a buyer for every seller and a seller for every buyer, and at some point futures contracts expire, and when they expire, if we're not out of our side of the contract, we have to execute the contract. So if I'm on the buy side of this futures contract and I don't get out when the contract expires, I have to deliver 5,000 ounces of silver to whoever's on the sell side at the particular grade that the contract specifies at the price that I got into the contract with. Everybody with me on this? Okay? And as a seller, if I'm not out, I have to take delivery. Well, what ends up happening is that as contracts come to expiration, everyone starts unwinding their trades. Meaning the buyers sell, the sellers buy, and what once existed as open interest starts reducing down to very little, if almost nothing, and the few that are left are the ones that want to take delivery or make delivery. Everyone else had no intention of taking or making delivery, but what the Hunt brothers decided to do was they wouldn't let the sellers out of their contract. In other words, what they did is they'd accumulated tens of thousands of buy contracts with no intention whatsoever of unwinding that contract, of actually selling it before expiration, forcing all the sellers on the other side to go into the cash market and deliver silver to the Hunt brothers. And at that point, the Hunt brothers had so much silver, they're basically having to buy the cash silver from the Hunt brothers to deliver silver on their futures contracts, forcing the price of silver to go up $40 an ounce. Is everyone with me on this? And then when the COMEX said, hey, you know what? COMEX said they said no more buy orders or whatever. Anyway, what went up, limit up 40-some days in a row, limit down 40-some days in a row. And the Hunt brothers took the gas on it. They ended up losing all that money. Is that what they did? I don't remember what they did exactly. Yeah, right. They said they're only taking sell orders, right? Yeah, well, whatever it was, yeah.
And do you mind if I just jump in?
Yeah, go ahead. No, come on. Yeah, go ahead. You need the mic? You need the mic?
No, I don't.
Okay.
The market's going to do, don't everything the market can do, always can never do that, because the market can't go wherever it wants to because it can. And during this Hunt brother with 8 days in a row, the chairman of the CME, Jack Sander, had a hog position on it. And there was a report on it. And the report was very bullish for hog. Hog should have gone with it out. It went limit down for 3 days in a row because silver was going. And Jack Sander was the chairman of the Chicago Market Stock Exchange, and this was limit down away from being bought. And that would not have made the Stock Exchange, which was still kind of in its, infancy, shall we say, not even its infancy, but still.
Yeah, pretty much though, yeah.
And that would have made the exchange look good. They were limit down for the third day. He walked out of the exchange and went to St. Peter's Cathedral. And came back and the hot market turned around. But the last thing it doesn't matter what you're trading. Something else, especially in these markets today, something else can go wrong. And you're like, well, why is that affecting my stock? Because it can. Because it can. Like how long do you have to go in there? Oh, right. Sorry. But anyhow, a market can go wherever it wants. And just don't think that it can't. And I'll throw one more thing out there. In 1987 during the crash, if you were short puts, S&P puts, you obviously got hammered. If you were short calls, and stock market went out 500 points in one day, you got hammered because volatility.
No, volatility, yeah. Right. So I've been on the wrong side of one of those. The market's going in my favor, and because I shorted the puts, it was in the D mark, and the market was screaming in my favor, and I'm losing money because of the volatility.
Right. Yeah.
I didn't think. I mean, I knew theoretically it could happen, but when it really happened, it's like, oh, okay, this really happens.
And, these were market makers that went out of business during the crash, and they had lines. They went all their lines. We're broke. I mean, we're broke. And they show up to clear house. The next day, I know my husband's cheating on me. Blah 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 blah. I know my husband's not cheating on me. We will get the fur coat and the ring.
Good morning, guys. This is Cody back from the live stream. A little late, about 20 minutes late. Had another rough one, but still gonna get this work done. Appreciate everyone that's hopping on. Like always, if you guys have any pairs or questions about the stream, go ahead, type it out below in the live chat, and we will go over it. So I kind of like yesterday's format, and if you haven't told already, like, I literally just experiment with any idea that I have on YouTube, and then I stick with the things that I like. So we're gonna go ahead and dig into it. Okay. Okay, so now let's dig into the pairs, right? So gonna first go through the three that we talked about yesterday, and then I know one person requested a pair yesterday, so we'll talk a little bit on that. I wonder if I can do this. Oops. No. That's awesome. Okay, so going through my three pairs, starting with GU. So talking about GU, I'm looking for a potential buying opportunity at the level that price has reached just now. Now price has scaled down to it correctively. So yes, this is a possible reversal signal to look for buys in this scenario. I would like to see an aggressive movement, like an engulfing candle in the situation, to confirm that. But stops are already in profit right above this high here. If price scales up, well, we stopped out in profit, but obviously we don't want to give up all that profit that we already have. So if I get an engulfing candle here, if I get a break out of this channel that's formed, I'll go ahead and close. In this situation, I'm not going to be taking the buy right now. Yeah, I'm not going to be taking the buy. I have to wait for the break of the trend line, a correction, a solid buy setup. Okay, I'm not going to be trading reversals at the moment. Other than that, just going to keep on waiting on GU. And for those like after we get through these pairs, I'll be back testing. And with back testing, you'll just have the behind view, and I'll have Mark Douglas play in the background. Okay, AUD USD, we still have the sell going. Price broke out of the pattern and has made a slight pullback. It's not a real pullback just yet. But still looking for price to push down. Nothing's really changed on this. And to avoid like confusing yourselves, we can look at the daily. Like the daily, this pattern is clear. And like all confirmations are met on the daily, and you can just watch the daily candles. Okay, Euro JPY. Man. Okay, Euro JPY. Got this impulsive move down, got this correction, and sold at this level. Then we got another impulsive correction after the break of that pattern, sold at this level. Now, what price is doing? Price is struggling to continue to push down. All right. So I'd like to see price continue pushing out, obviously, because I have 2 positions on with it. But like I've been saying all week, if price, actually since last week too, if price breaks above this trend line, we start looking for buys. As long as price is below this trend line, continue looking for sales. So that means continue holding the sales. So nothing for me to do here either, which are some really good days. Like a situation like this are some really good days because I don't have to make decisions. Like I just have to follow my plan. And as long as I'm level-headed, I know I'll stick to it. Let's go to dollar yen, and it's kind of peaceful. It takes my mind off the charts. So dollar yen broke out above this high, and we have a potential expanding triangle. I need to see some type of retracement, or I need to see price break this trend line whatever way it does, whether it breaks it correctively, whether it breaks it impulsively. I just need price to come down. Can't have price just pushing up straight like this. Need some type of retracement to form. Okay, and internally I'm having a conviction, and I have to say, like, I don't stop thinking about the charts on days off. It mainly just back tests. It gives me a chance to do other things that I usually wouldn't do as far as study wise. I felt like I just couldn't keep going without saying anything about that. Dollar yen. Yeah, that's it. I just need the trend line to be broken. Since that zone is broken above, I'm going to validate that. There is a level right there, but I'm going to wait for the trend line to be broken. There's no point in trying to catch it at the top. Let's wait for solid confirmation for that. Okay, now gold and US 30. Absolutely beautiful. So gold buy setup playing out perfectly. Hasn't officially pushed up all the way, but we are in profits with this P&L that I placed here. Yeah, and continue to look for it to push up. Now I'm expecting this to be very sustainable movement to the upside. So after that break of this high, look for a solid correction and then look for a buy. Now could get in early here. Looks like there's a lower time frame uptrend here. Let's go down to the 15 minute. Now It's not something I'm supposed to be trading. Since it's not something I'm supposed to be trading, I should probably get out of the habit of doing this. Yeah, I'm gonna have to stop going down to the 15-minute. This scenario is just so clear. This is the last time. Okay, I'm gonna try to make this the last time I go down to a lower time frame, because I need to continue to stay on my 4-hour 1 hours. It was just so clear. I just had to point it out. But looking for something like this on gold on lower time frame. On the higher time frame, I'm looking for this impulse to play out and then a correction to form off the 1 hour time frame. And we finally have something new, so let's go ahead and send this out. Now, I like threads, but I don't like that. I don't like how they disappear after a certain period of time. Okay, let's go to US30. Oh, that's even better. Okay, so it looks like there was a sell signal here for this impulse down and correction. So if you took it, would have lost that trade. Now price broke above and made new highs, which is really, really good. It means we need to start looking for buys. Correction of the 30.2 is most likely. Yeah, I like the flat pattern in this situation and then look for a buy there. Now, right now, I'm not seeing any questions or charts that anyone wants to go over. Let me pause that. So that means it's going to be about the last chart that I go over. Yeah, so, and it's time for me to start backtesting.
And the market was screaming in my favor, and I'm losing money because of the volatility.
Right. Yeah.
I didn't think, I mean, I knew theoretically it could happen, but when it really happened, it's like, oh, okay, this really happens.
You know, these were marketing.
And so it didn't really take much for me to say, you know what, I'm going to Chicago. And, you know, so the first thing I did, I thought, you know, I checked things out, and I found out that Merrill Lynch, their retail brokerage office, Merrill Lynch Commodities, they're on the second floor of the Chicago Board of Trade, and they had 3 positions they're opening. They're going to be open for trainees. And my understanding is they had over 1,000 people apply for those positions. And so, like, how was I going to be one of those guys that the 3? What I did, because I live in the Detroit area, I went and applied for a Merrill Lynch position at a branch office in the Detroit area. Went through the whole process because they had, you know, aptitude tests. So you had to take aptitude tests, and you know, but here, the most important part of it, the most important part of the process, I thought anyway, was that there's a multi-page application because of the tests. But otherwise, there was this box at the back, at the last page, and in this box you had to spontaneously write there was a question that was asked. It was somewhat philosophical. It was somewhat of a philosophical answer because they wanted to know probably, you know, how focused and how well you could write something like that under the pressure of being in a job interview. So anyway, what I did is I assumed that the whole process would be the same at the Chicago Board of Trade, and it was. But what I did do is I spent probably 2 or 3 weeks agonizing over every single word of that answer. I mean, and by the time I was done, I even had to admit it was somewhat brilliant. Okay, so I went and applied at the Board of Trade, and of course I aced the aptitude test because I've already taken it. And then if the branch manager thought that I wrote that answer just sitting there spontaneously, okay, because I had it on a 3x5 card, he's got to think, this guy, hey, I'm going to hire this guy. And that's how I got the position at Merrill Lynch. So then people, you know, it's like, no, what did I get myself into? I got myself into a $20,000 a year draw on commissions. That's it, a $20,000 a year draw on commissions. I left $360,000 for a $20,000 a year draw against commissions, and there wasn't anybody in my life that didn't think I was absolutely stark raving out of my mind. Like, how could I do it? It was easy. In my mind, I wasn't giving up anything. Now, it wasn't a revenge trade. I just thought, look, I didn't know anything about trading, and I got myself into a trade that had a potential of $400,000 on 2 contracts. What did I know about the markets? Virtually nothing. What did I know about trading? Virtually nothing. So in my mind, did I give up $360,000? Not really. I'm going to go make this when I get to Chicago. I'm going to be on the inside of the business. And as a result, I'm going to learn how to trade. Only to find out that, especially back then, there wasn't anybody at Merrill Lynch who knew how to trade. Seriously, I'm not kidding. I'm really not. I'm not saying that facetiously in any way. They didn't know how to trade. They knew how to talk about trading. They knew how to open accounts and teach you how to open accounts. In fact, I went through a 30-day training session in Manhattan, and not one moment of that session was spent on teaching us how to trade. It was all about how to sell your customer and how to talk about trading in a way that made it seem like you knew how to trade. So when I got on the inside of the business, I was outraged. Seriously, I was enraged. I really was. It's just like, and it took me a while to get over that too. But anyway, the problem is that here, you know, I gave up all this income, and I had money, but it was like, you know, I also had an extravagant lifestyle. I still had a house in the suburbs of Detroit. I had a really nice, you know, apartment in downtown Chicago, not that far from, you know, the Board of Trade. I had a Porsche. You know, I had a girlfriend in, you know, the Detroit area, and, you know, going back and forth every weekend, and, you know, the whole works, right? I mean, just like, you know, just my lifestyle could only be supported if I made money as a trader. Yeah, exactly. That ain't gonna happen. And at the back of my mind, it's like right after I get there, it isn't too long for me to start figuring out, you know what, this isn't adding up. This is not adding up. It's like nobody knows what the hell they're doing with respect to trading anyway. I started making friends with floor traders, thinking they knew what was going on. They're in a completely different world. I mean, you know, floor traders and direction-related traders like what we do, screen-based traders, we call each of the floor traders will call what they did as trading. We call what we did as trading. We're in completely different worlds. They did not make, in most cases, did not make direction-based decisions. They made scalping decisions that turned into direction-related trades. I'm not even going to get into how all that works. It's just not necessary. All I'm saying is that, and not only that, they're also boom and busters too. So all this is like, you know, it's like, whoa. You know, and so it's getting to the point where, you know, as things are going on, you know, and I'm doing, I mean, not only that, I mean, one of the good things about being at the board, or in that Merrill Lynch office, is that they had a computer, or a terminal actually, that was that had a direct phone line to a mainframe computer in Boston, I think at MIT, that I could call up a tick chart even on anything at any time. In other words, if this was in like 1981, if I wanted a tick chart of wheat on Wednesday, Wednesday, March 14th of 1951, it would give me one. And I'd build a tick chart, all the way to the present moment. And at the time, I was doing point and figure charts, so like I could build up point and figure charts, anytime, they're not based on time, but any box, any reversal size, and it would go back as far as the contract went back. So, and I spent almost all my time at that terminal learning technical analysis, whereas there were like almost, there were over 40 brokers in that office, and I was the only one that used it. I was the only one that used it. So anyway, like I said, things aren't adding up, and it gets to a point where I'm running out of money because of my lifestyle, and to the point where it looks like I'm going to file bankruptcy because I don't have. The thing that was so important in my life, even at the time, probably one of the most important things in my life was my credit. I would do anything to maintain flawless credit. I mean, whatever it took, anything. So the idea of not being able to pay my bills was completely unacceptable to me. It was like I believed that if I had to do something like that, I would fall through the cracks of society and never reemerge. I mean, you might think I'm just saying this. These are not words. These were a reality in my mind. I could not fathom what that would be like. Just couldn't. But in essence, that's essentially what it came to. Now, if you're thinking to yourself, okay, as you realized that that you're running out of money, and I wasn't running out of money because of trading losses either. I was trading, and it wasn't because I didn't take big losses. My problem as a trader was because of all the pressure that I had of having to be successful, of having to prove that I didn't make, to family, friends, whatever, that I didn't make this asinine decision of leaving $360,000 for a $20,000 a year draw against commissions, that every trade took on the significance of, took on just a degree of importance that was just way off the chart. And so if I took a losing trade, every trade had to work. I was working off a level of 100% perfection. Every trade had to work. And if it didn't, it would set me into an emotional tailspin to the point where it took me days, if not originally almost like weeks, to recover. Now, in the meantime, so to recover to the point where I didn't want to even have anything to do with the market. I didn't want to watch the markets. It was so traumatic. But as a broker, I was in a position of maintaining my customer accounts and giving them recommendations. So what would end up happening is that as I'm keeping in touch with the markets for the sake of my customers, I'm giving them my best edges, which in many cases were really good. But when I talked to them, it's like it always came with a disclaimer, like this trade might not work. And so it resonated as a truth when I said it to them. But in my mind, it was just lip service. Seriously, just like. I'm going to get into a trade that's going to work, or that's it. So what ended up happening is that I would take a loss, and then I would be in a position where I'm giving my customers my best edges, and and all I had to do was fill out a ticket for me, but I couldn't do it. I was paralyzed because this was the hard, like the situation with John about realizing that he was in a hero cycle. My cycle was that by taking a loss, I didn't deserve the next trade. It's like I was punishing myself. I didn't deserve to participate in the next trade. And when that next trade was a winner, it would like put me into a state of anguish that was so painful that it had actually the positive benefit of knocking me out of it, because it's just like the sense of self-preservation would kick in. And it would have the, like knocking me out of the sense of anguish that not wanting to go through that kind of pain again, I would be determined to take the next trade. Especially when that next trade that I didn't take was a winner, and they almost always were. So here my customers were benefiting from these winning trades, and what I needed so desperately, I wasn't even participating in. Well, in any case, it was a real bad way to trade, so I ended up losing. Like I said, I didn't end up having to file because of losses. It was the fact that I wasn't making the kind of money that I needed as a trader. So if you think to yourself, well, okay, as your expenses were way out of sync with your lifestyle, why didn't you cut back on your expenses? Well, think about that for a moment. If I cut back on my expenses, I'm admitting to myself that I'm failing. Even thinking about it would be putting me into a mode that I'm admitting that I'm failing. And what made it even doubly more difficult to make that admission is the fact that I had a really good win percentage. I came up with good trades. If I could execute them, I'd have been all right. So it just always seemed like I was only 2 or 3 trades away from everything being all right. So how can I admit that I'm failing? Until I literally did not have any more money to pay my bills. And then I called, credit cards, and even called GE Credit, who, had the Porsche, and I wasn't even late. Wasn't even late. I said, hey, come and pick up the car. I can't pay for it. They're out in Bloomington, Illinois. And what was really interesting about that, you want to hear this? I don't know if you want to hear it. It's a cool story. The guy they told to come pick it up, I met him out in front of the apartment building. And I can't use the exact language his supervisor used, but I'm thinking, you know what? This guy's picking up my car, or what was my car, and I want a note that says what condition it's in. In other words, I go back and make things right. I don't want the car, going back to GE Credit, dented up or whatever, any kind of situation that I didn't occur. And I said I wanted a note. And he said, I'm not going to give you one. And I said, you're not going to get the car. And so, we went back and forth on this. So finally, he walked into the lobby and called the supervisor. And I could hear his supervisor on the other end. I said, if you have to blah, 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 this guy's whatever, you get whatever you do whatever you have to do to get those keys. He's screaming at him. So anyway, I can't use the language, but it's like, you can imagine what he said. So, but yeah, so what ended up happening is that I lost all my possessions, other than the fact that I still had my job at Merrill Lynch. When I filed, I did so in the Detroit area because I had a legal residence, so nobody at Merrill Lynch knew what had happened. They would have fired me immediately. And I was in the unique position. Now here's what's really critical about all this. I was in the unique position of legitimately having tapped out as a trader and still able to trade, still being connected with the markets. And I had also the added benefit of just always sort of knowing right from the very, very beginning that trading was about psychology. As a matter of fact, the very first book I ever bought as a trader, the very first trading book I ever bought was Jake Bernstein's Investor's Quotient. It was published by Wiley in 1980. It was more on a clinical level, but that was the very first trading book I ever bought. It was on psychology. The only one actually, like I said, the very first, I don't consider Reminiscence of a Stock Trader like a real psychology trading book. So Jake's was the very first book. Actually, The Disciplined Trader was only the second. The Disciplined Trader came out in 1990. Yeah, at that time, it was only the second book ever written on the psychology of trading after Jake. And even at that time, there weren't any universities that had behavioral finance programs. It just, the whole idea of trading psychology in the industry was completely this doesn't have anything to do with anything. So anyway, so what ended up happening is that it was really cathartic because I ended up realizing that I was more than my possessions. After, I don't know how many weeks it took, but I was starting to reassess my identity. When you have all these possessions, that are on the outside of you reflecting what's on the inside of you, and then all those possessions are gone, it's like you've got to reassess who you are. And then I came to the realization that, I'm more than my stuff, and I'm going to be all right. And it's when I really genuinely came to the conclusion that I was going to be all right that I didn't have anything to lose anymore. And I saw a different market. I come in, and it's like it was like almost like things became self-evident. When I didn't have anything to lose, it's like I was completely detached from the outcomes. And with being completely detached from the outcomes, I was in an objective state of mind, and it all became easy. It really did. Someone has a story here. I don't remember your name, sir. Oh, because you didn't have a tag on. Scott, you want to say your story? Yeah, you've got 15 seconds.
I've been trained about 13 years now, and it was sort of on my own. I learned from 2 other guys who were the 3-point license. And I learned a lot of bad habits by taking losses and taking personal. And I had read one of the books 4 times over. The 3 times before, I understood the story, but I didn't make the connection. And the 4th one, it happened after I took the loss to go back to the start. And it was to the point of dislocated right at the head. You have nothing left to lose. So when I read the book, October, November,
The 4th time. Yeah, the 4th time.
I get it. And my trading firm, because I now was not trading with the firm, now I judge myself because that's problem. And then in the spring, I worked with John, and the Washington State trade where the case are trade for months. And the full green weekend, I watched 4 or 5 months of stuff, and I got it. Sold off in that one morning, and days I got a 54% capital. So, we're going to go ahead, it's like, that's fine. The trade futures don't have a lot of time to be on. This gave another tool to go off the trade, and it sounded fun. So I still want to it's a pain for everybody. And he said, I don't want to lose it. That stress, it made it. So that was my story. Now my trading is fun. So we can start the fun. And enjoy.
Thanks, Scott. Appreciate it. Thank you. Forgot to put it up there. It's all right. So anyway, before we break for lunch, there's some stories that I want to go through that'll illustrate these points when I was at Merrill Lynch. First of all, if you're interested, why did I leave Merrill Lynch?
Yes.
Okay, I got fired. And no, the reason why I got fired is because in the summer of 1982, this whole situation was like around April of 1982. By July of 1982, I'm thinking, you know what? As I experienced a different market because my perception, my perspective had changed, I thought, you know what, I got to write a book about this or a seminar. I didn't think about really a book, but I thought more like a seminar. And I actually started writing it in July of 1982 in the boardroom overlooking LaSalle Street. There's a huge picture window there, you know, on the 2nd floor of Merrill Lynch, okay, or 2nd floor of the Chicago Board of Trade. Anyway, about 9 months later, 9 or 10 months later, some management consultant from New York came to our office. She had some agenda. I don't remember exactly what it was, but she was interviewing all the brokers, and she got to me. And I told her that I was writing this book on the psychology of trading. She lit up. I mean, she honest to God, she just lit up. And we talked for about an hour. And I told her what I was doing. She said, "This is exactly what we need. Boy, this is great." Blah 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 blah. And so, you know, when we were done, she went right into the manager's office. She was in there for about 15 minutes or so. Manager came out and said, "Pack your shit up and get out of here." Did not want anybody on the inside of the industry writing a book. Now, you know, it's not that he didn't know what I was writing about. He didn't want to take the chance. He just said, "Get out." That was it, right then and there. So I said my goodbyes to everybody and left. But anyway, here's some things that illustrate some of the points that I learned while I was at Merrill Lynch. One, there was a book that I bought, New Technical by Wells. I don't remember the name of the book. Anyway, all it was there was about 5 or 6 technical, rudimentary, by today's standards, very rudimentary technical systems that Wells Wilder, the author of the book, actually gave you a spreadsheet for, so you could actually, you know, do all the additions, multiplications, and divisions all by hand because we didn't have computers, and based on daily charts. And some of these signals were really quite accurate. I mean, they really were. They're based on, like I said, daily charts. They're really quite accurate. And so I started using them for my customers. And so one of the things that surprised me, because I was making friends with a lot of floor traders, is that when I got a signal, in some cases it was absolutely perfect. It's like, get me in a trade that, that I didn't take any heat on whatsoever. And I'm thinking, like, I remember exactly thinking, like, is this the reason why the market's going in my favor? But I do have a recollection, like if it was a bond trade, of going out to have some beers after the market with bond traders, and they're telling me about the activity in the pit, who's buying, who's selling, volume. And I'm thinking, there is no connection whatsoever between my winning trade and why the market went in my favor. I mean, zero. Were those 4 traders using this system? Absolutely not. Zero connection. The next one. Sophisticated financial news channels didn't exist back then, but we did have this local cable channel in Chicago that during the day had financial news or whatever, stories. And it was really rudimentary by today's standards. So the TV would be on constantly, so you could watch it if you wanted. And we also had, like, CNBC, like what they called, like in the morning they called Squawk Box. Well, everyone know what a Squawk Box actually is? Because they really exist. A Squawk Box was an open phone line between all the different pits that would be traded. That we would we'd have a speaker located in various parts of the office so everyone could hear it, and there would also be an open phone line in, like, the hog pit, the bellies, the T-bonds, the S&Ps, you name it, the currencies, whatever. And there would be Merrill Lynch employees whose job it was to go to these various pits throughout the day and report about who was buying and who was selling and how much. Like, okay, so-and-so was doing this, so-and-so was doing that. And so I'm watching this local channel, and they're interviewing some vice president from Heinhold Commodities. Heinhold Commodities, I don't think they exist. I'm sure they don't exist anymore. But they used to be one of the biggest hog producers in the world at the time. And so their vice president was being interviewed by the guy on this cable channel, and he's just talking up, buy hogs, buy bellies, and it's like, and the office was relatively quiet at the time. Then all of a sudden the phones started lighting up, literally, and lighting up because you had a lot of local commodity traders, off the floor traders in the Chicago area who watched the station. And so what are they doing? They're buying hogs. They're sending orders to their brokerage firm, and in this case, Merrill Lynch, buying hogs or buying pork bellies. And so, this is a coincidence. It just so happened because the guy, the Merrill Lynch employee on the floor, whose job it was to report what was going on in the pits, he wasn't watching that station. He wasn't watching the local news cable station. He didn't have any idea that there was some Heinhold vice president on TV telling the basically retail customers to buy hogs. But he just happens to walk into the hog pit because he hears all this activity. He sees all this activity flowing into the pit, especially into the retail brokerage deck holders. And he wants, say, he'll go report on what's happening. So he goes on the pit and say, all these retail orders are sure said Merrill Lynch, blah, 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 blah. And guess who's on the other side taking the sell side of those orders? Heinhold. They needed inventory. They needed buy inventory to absorb their hedge without affecting the price of the market. This happened a lot. This was not an isolated incident. This is the kind of stuff that goes on all the time, or did. This probably still does. I don't know. And so, and the next one, the last one that really like I had, where I really for sure had to write a seminar, is because when I was at Merrill Lynch, what I saw is all of our customers making all the same kind of mistakes over and over and over again. It was just like there's the typical things that we all basically had the same problems and making the same kind of mistakes. And I inherited this guy as a customer. He was from India and had a real heavy Indian accent, and he was the main. He ran the state of Illinois' main computer banks. In other words, the mainframe computers. And as a result, since he had access to these computers, he was also developing trading systems using the computer. And so, like I said, I inherited him as a customer. He didn't have an active trading account because his wife wouldn't let him trade anymore. But he did have an open account. So he would call me every day, and he was not a very personal guy, because I'd pick up the phone and he'd say, give me data. Okay, so I give him the data that he needs. And eventually what he did is he came up with a system that was really quite accurate. In other words, at least entries anyway. He had really accurate entries on a daily trading system, like on the open, on the close kind of thing. What he didn't have was exits on the loss side and profit objectives. And so I worked with him for about a month on this and came up with a really viable system. It was working, and not only was it working, it was starting to take notice from Merrill Lynch management because my customers were making money. Literally, I mean, that's not something that really happened in a retail brokerage firm. So, and then it got so good that he talked his wife into putting $5,000 in his account, and it was like, whoa, it was gone in a day and a half. It was like he called me with the signals, but then he'd say, well, do this. I said, well, no, then our signal, we're going to do this for his account. No, do this. I said, no, the signal is to do this. He said, I know what's going to happen, do this. And he lost the $5,000 like that, just like that, not following one rule of his. We had a track record. We had a legitimate track record that was working, and he couldn't take one trade from his own trading system. He pissed away the $5,000 in a little under 2 days, and his wife said, that's it, no more. And that was it for me, too, because, he closed the account, and I never heard from him again. And since we didn't have mainframe computers, nor did I have access to what variables he used to call for the signals, it was done. It was those kinds of experiences like, you know what, I got to do something to, get people in tune with what's really going on here. First of all, don't let me forget, tomorrow I'm going to start out showing how fear causes us the fear acts on our perception of information and our behavior in a way that causes us to actually experience the very thing we fear the most. And then we're going to put it all within a context of a step-by-step methodology of how to actually instill these principles in your mind as core trading beliefs so that you're not afraid anymore. Go ahead.
Your story about newscasters that say 5 pork bellies and then
Hogs, yeah, right.
is that sort of opposite of what you said? Like, how do you know that's what it was? How did that influence you?
What do you mean? What are you saying?
People always say this is why things happen, but nobody knows you can't do anything. You're just stories.
Okay, but what does that have to do with the story that I said?
Pork belly.
Yeah, he did that because he did. Oh, he went on TV to tell people to do that, so there were orders to take the other side of his trade. He needed inventory. In other words, remember, prices move based on an imbalance between the number of buy and sell orders that come into the pit. But he's a hedger. He doesn't want the price. He doesn't want his sell order to cause the price to go down because it reduces his average price. He wants to sell at the highest price possible. The only way to get his price at the highest price possible, if there are enough buy orders to take the inventory of the amount of sell orders he has to sell. So he went on TV encouraging people to be buyers so that there were enough orders to fill his hedge. He didn't want the market to move. Go ahead. Oh, in this case, yeah, absolutely. Yeah, see, remember, I didn't say that was an absolute. I didn't say it was an absolute because the Merrill Lynch employee was right in the pit seeing who put the order in. He still didn't know why. The Merrill Lynch employee said, hey, you know what? Heinhold is selling. Here's how many. He didn't know that they were putting on a hedge. Oh, it wasn't a good bet at all, actually. No, it was a complete scam. No, what are you saying? No,
I understand that this person that ordered maybe they
maybe we say ordered. Ordered what? What do you mean?
placed an order for
I mean, place a buy order or a sell order?
buy.
Okay, they're putting buy orders in.
Earlier you're saying you don't know that people are black market looking much but buying.
Right.
Looks like this guy came on TV and
Oh, absolutely, yes. In this case, I would say because the coincidence of the phone, of him being on TV and the phone's lighting up, yes, I could say in this instance that probably the reason why those buy orders are flowing into the pit, yes, did I know at that, the probability is, yes, it seemed like I contradicted myself, but I really didn't because as screen-based traders, remember, I was on the inside. I was in a brokerage firm with access to information that we don't have as a screen-based trader. Remember, I qualified it by saying, as screen-based traders, there's no way to know. Was that part of your question? Okay. Yeah, remember, I was on the inside. So I could see the correlation. Go ahead.
Did you ever ask any or all of the students who never did any of your protocol, why they never did it? When going back about a quarter of the way of your presentation that you talked about.
No, I normally, no, I wouldn't ask. That's not something. No, I kind of know why. I can extrapolate why, but no, I wouldn't ask.
Why?
I really wouldn't want to say, actually. You know, I don't want you guys to not do it. Okay, so you know, what? Well, you might not want to if I gave you the answer. It's right. It's what you're going to learn. Not everyone's ready. Not everyone's ready to step into what they're going to find out about themselves. That's right. Not everyone's going to want to know what they're stepping into and what they're going to learn about themselves, because the implications are pretty powerful. You know, it takes away a lot of people's excuses for being unhappy and a lot of negative things that go on in their lives that they'll learn they can do something about. Because if you can change one belief, you can change any belief. So there, I answered the question. That was a good question, by the way. And, one other thing. Another thing. Okay, because I don't think I finished this. Yeah, another example. There was one particular example where the bond market had really established support and resistance zone. Okay, and this was an intraday trade, and the market came down to support and bounced right back up off, came down to support again, bounced right back, and now it's coming back down again, right? Okay, and so like the third time, well, I'm getting everyone in this trade, and what does the market do? It just blows right through it. Now, it's like under normal circumstances, I wouldn't have the slightest idea what happened. It just so happened that because, again, I was having beers with guys in the bond pit that, you know, who were in the pit that day, asking them, hey, you know what? When the market was at this price and it bounced, the market was at this price and it bounced, and then it hit it again, like, you know, an hour or so later, and it blew right through it. What happened? Oh, well, there were 4 or 5 really big bond traders who were supporting the price here. In other words, more buy inventory than sell inventory. They did the same thing again here. They were out to lunch here. They went to lunch. I lost money my customers lost money because they went to lunch. That's why the trade was a loser. Hey, see you tomorrow. Okay, before I ask you guys if you have any questions about some of the stuff we did yesterday, I just want to elaborate on something that John just said, because it's really important. He said, when you understand probabilities, there probably isn't a person in this room who doesn't understand probabilities. It's being able to function from a probabilistic perspective. There can be a huge reality gap between, let's say, our understanding of what it means, of what probabilities mean. Like, you know, saying, hey, our pattern gives us an edge, you know, over a series of trades, over a series of 10 trades, 7 are going to be winners, 3 are going to be losers. The problem is we don't know which ones are going to win and which ones are going to lose. So if I'm going to actually extract the profit potential in that edge, it requires that I be able to take every single trade in the series or the sequence without making errors. Makes sense, right? Wait, understanding that core of your personality, so that you can actually do it, are 2 completely different things. We can say we can think of ourselves as a probabilistic thinker. Say, yeah, oh yeah, I get it, I understand it. But if you can't execute all 10 trades flawlessly, then I can guarantee you you can't function at a probabilistic perspective. Because when you can, you will be able to lose without thinking you're a loser. You will be able to be wrong without thinking there's anything wrong with you. Because that's in essence where we're going. This is what makes trading so hard. We live in a society that's completely obsessed with winning is everything. Avoid losses at all costs. Winning is everything. Avoid losses at all costs. These are very powerful belief systems. You think they're just going to go away and not assert themselves on what you do and how you behave just because you have this understanding in probabilities? Just because you might read a book or go to a conference and say, hey, you know what? This is a probabilistic environment that we're dealing in, and, you got to think in odds. Oh, yeah, that makes sense. I can see that. Try doing it. Because what you do is going to be a function of what you believe. And if you can't do it, it means that there are conflicting beliefs that say that, you know what? No, this is not right. I think my analysis should tell me what's going on. And even though at a conscious level you're thinking, no, that's not what this is all about, it doesn't mean that that energy isn't asserting itself on how you behave. Otherwise you wouldn't be afraid. You were at the casinos last night. How is it that if we lose, it taps us into, we have a losing experience. It can tap us into all the accumulated negative energy, like I put yesterday, of what it means to lose in our life. Losing has a potential to tap us into all this negative emotional energy. I don't want to feel that way. Most people with, let's say, a normal psychological makeup also don't want to feel that way. We will avoid this at all costs. I don't like the feeling of what it means to be wrong, all the negative energy. Brings up all the times we were berated as kids, someone ridiculing us, teachers, coaches, whatever. So if my training experiences have the potential to tap me in to these two belief systems, or these memories, the memories of what it means to lose and what it means to be wrong, well, you know what? I've got big problems, because you know what? If I can't lose and I can't be wrong without it resonating, negative emotional energy, there's only got one other way that I can think of to help me avoid tapping into all this, and it's through analysis. So in one sense, we're going to say, well, I'm a trader, which means I'm a risk taker. But the reality is we're using analysis to do everything to avoid tapping into the memories of losing and the memories of what it means to be wrong. And it doesn't work. What we're trying to tell you is this doesn't work. Because there isn't any analytical regimen or system that you can come up with that will guarantee that the next trade is going to work. What technical analysis does is it defines patterns. In other words, when we got the order flow, we got buys coming into the exchange, we got a flow of sells coming into the exchange. When there's an imbalance between the buys and the sells, and there's no buys, the price has to tick up. When there's an imbalance between the sells in relationship to the buys, the price has to tick down. As these price up and down, as the price ticks up and down, up and down, up and down, up and down, it creates what we call collective behavior patterns. I say collective because everyone who submits an order to the exchange contributes to the pattern. And what we found is that not only can these patterns be identified, quantified, but they repeat themselves with statistical reliability over and over and over again in every time frame. You guys with me on this? Where's the problem? What? Go ahead, Tony. Oh, well, yeah. No. The problem is the patterns repeat themselves over and over again with statistical reliability. The outcomes that the patterns are predicting are random. I want you to get this. This is big. Okay? The patterns repeat themselves with statistical reliability, but the outcome that the pattern is predicting is random in relationship to the previous outcomes. There's a completely random distribution between wins and losses over a series of edges, or the criteria that define your edges. Exactly. That's right. That's how casinos make money. They're gambling on each individual. They know that's a gamble. Each individual outcome is unpredictable and unknowable. But over a series of events, the law of probabilities will work its magic. And they don't need to worry about the outcome to each individual event. So now you tell me, nobody likes tapping into the pain. No one likes tapping into the pain. And yet walk into the casino and watch people sit in front of a slot machine for hours and pump money into that machine knowing they're going to lose. Not only knowing they're going to lose, experience losing. And why is it they're not experiencing emotional pain? They are losing. Why aren't they experiencing emotional pain? Well, it's one at a time. Somebody raise their hand. Whatever. Go ahead. Yeah, well, no, let's put it this way. You say they're expecting the next one. They don't know if the next one's going to be a winner. The next one may be a winner, and the whole idea of it being fun is because they're going to be surprised if it is. But the point is, they are expecting wins and losses. As a matter of fact, if you watch somebody play slots or you experience playing slots, you know that you're going to lose more times than you win. And as long as you accept the risk, meaning, and how do you know you accept the risk? Your behavior will tell you accept the risk because you don't have any problems putting the money in the machine. See, if you couldn't accept the risk, then you would find it difficult to actually put the money in the machine. Gambling forces us to accept the risk in advance because if we don't, we can't play. You can't sit down at a blackjack table and just decide to play and without putting your money out there first. They won't let you. But the illusion that analysis creates with trading is that I can actually get into a trade and believe that I'm not taking any risk. And if the market happens to go in my favor immediately, it's without giving any heat, it gives me, it reinforces the idea that yes, I can do this without risk. I can do this without risk. I don't have to experience this if I just find the right method. That method doesn't exist. Get it in your brain. It doesn't exist. If I had a method that produced 99% winning trades, I guarantee you, if you're risk adverse and you haven't accepted the risk, you will not make consistent money. You'll always be worried about that one time. That's why, you take a trader who, has, 9 out of 10 winning trades, maybe 4 or 5 or 6 or 7 in a row, and you're talking to other traders at conferences and chat rooms, and they'll tell you about all these winning trades that they had. They didn't tell you that the 10th trade they lost all their winnings on the first 9 and more. They didn't tell you that. Yeah, 9 out of 10, 9 out of 10, yeah. And do they have to lose all their winnings from the previous 9 trades? Did it put a stop in? No. Did it define the risk in advance? No. And why didn't they define the risk in advance? Why did they not put a stop in the market? Because they thought they had a guaranteed win. It's that simple. Do you think that people could sit there and play slots for hours if there was the emotional risk? If there was the emotional risk that traders have about if they're wrong or they lose, they're going to tap into that pain. We don't enjoy that. It has to be enjoyable. The emotional risk of playing slots for most people just doesn't exist. They're enjoying themselves because they know the outcomes are random. They know they cannot, it is senseless, it would be an effort in absolute futility to think that they're going to predict what the pattern of those wheels are going to come up with on the next spin. They might not know anything about the architecture of the computer chip that generates the random outcome. But the point is, it is a purely random outcome. And when we learn that it's purely a random outcome, the whole idea of predicting or even being right or wrong is irrelevant. It doesn't apply. Does not apply. And so it takes what we're doing, the activity, out of a right or wrong context. And so I can sit there and push the button, and there's nothing to be right or wrong about because I'm not predicting the outcome. Now, that's a little bit more tricky in trading because we're using an analytical process to actually make a prediction. But what we have to do is we have to apply the principles of the law of probabilities on that prediction and say, you know what, this is a prediction, correct? Okay, I mean, this is, yes, I am making a prediction. I don't have any illusions about the fact I've used this analytical process, I've come to a conclusion, I'm making a prediction, but you know what, it's still just a guess. And in that way, we're not responsible for what the market does after we put on a trade. How can we be? When you understand order flow, when you understand there is no way that I can predict the intent that other traders have after I get into a trade. There are other traders all around the world waiting to enter orders for whatever reason pops into their brain. Whatever agenda they have, whether it's commercial, whether it's contractual, whether it's hedging, or whether it's pure speculation, they have their reasons for sending a buy or a sell order to the exchange, and how big that order is. There isn't anything that we're doing from a technical or even fundamental perspective where the mathematics of our system can predict what those guys are going to do, or women, okay? There's just no way. In essence, I'd have to know who's about to send an order to the exchange, what kind of orders are going to be. Is it going to be a buy or a sell? How big is it going to be? And then with that, you could say, okay, well, we've got all these buys coming in, we've got all these sells coming in, and so in this moment right here, we should get an uptick. But then again, let's say in the moment there's a huge abundance of buy orders coming into the exchange that overwhelms the number of sell order inventory to take the other side of those trades, and the market starts to shoot up. But then some other trader somewhere in the world sees the opportunity to what he thinks is sell high and just slams that rally with a huge order. Now you would think, well, who could trade that big? Well, hedgers can trade that big because they're not taking the risk. They're eliminating the risk. They're already long or short. They're already what I call naturally long and short based on their business. So yeah, they can put that big of an order in the market and actually defend a price. You heard words like defending a price? This is what it means. You tell me how a mathematical equation is going to predict that. Somebody please. But that's exactly the way you trade, isn't it? Isn't it that exactly the perspective in which you take? You think that this mathematical equation is going to accurately tell you every single time what the intent of all these other traders are around the world? It's just a probability game, everybody. That's it. And analysis makes us think it's something else because of the erroneous connections that we make and erroneous assumptions that we make. It's like, yeah, okay, I've said it again. I did my analysis. I made a prediction. The prediction was absolutely correct. So the reasons why I made the prediction must be the same reasons why the market went in my favor. And that way, I knew what was going to happen. I knew what was going to happen. Making us think that the risk cannot exist. If you're trading to avoid being wrong, if you're using analysis to avoid being wrong in any capacity at all, even just the tiniest bit, if you're using analysis to avoid being wrong and avoid losing, it doesn't work. The only way you're going to make this work is to adjust the way you think, is to change your perspective, that what you're doing doesn't have anything to do with, you're going to need, your predictions have to be correct, but your reasons for making the predictions do not. In most cases, for the typical screen-based trader, most of the trades they put on, there's virtually very little correlation between the reason why the market went in their favor and the reason why they put on the trade. Very little correlation. And what do I mean by correlation? How would I find that out? I would have to be able to inventory. If I went long based on a moving average, and my moving average crossed, and I put a buy order in the market, and then 3 or 4 minutes later the market started rallying, and I'm thinking that okay, that's I have the right reason for making this. My technical reasons must be be correct because it made the correct prediction. I would actually have to go out and determine all the traders who put buy orders in the market that actually caused my trade to become a winner, because I couldn't make my own trade become a winner. I can't trade at a level where, for an example, if and there are a lot of traders who can, a lot of traders who have strategies to do exactly this. Okay, that when they see how many bids and offers there are at certain price levels, at certain significant reference points that they know they might be able, like I said yesterday, like stampede people out of a position or even into a position that helps them out, okay? All they have to do, if the price is at 10, all they have to do to bid it up to 11 is just simply take out all the offers. If there's X number of offers at 11, all they got to do is hit them. That's it. And the price automatically goes to 11. Then all they have to do to get it to 12 is hit all the offers again. That's it. They're actually creating their own price movement. They know why the market's moving. They know why it's moving because they're doing it. And they are making their own trades winners. Because everyone who took the other side of their trade at 11, when it gets bid up to 12, is a loser. Everyone who took the other side of their trade at 12, when they bids it up to 13, is a loser. Now, this can be a dangerous strategy. You have to have a lot of capital and a lot of balls, because as their position size grows, for them to get out of that trade, what do they have to do to get out of that trade? They got to reverse everything. In other words, they have to become sellers, which means that if they have a huge position that they built, a huge long position they've built up, there has to be buy inventory for them to get out of that position. In other words, they become sellers. And if there isn't enough buy inventory for them to get out of that position, they can actually force the price right back down again. That's what they, well, you know, hey, yeah, it's like, right. You know, there's a very famous guru on TV, I'm not going to mention his name, but about 6 or 7 years ago, he was doing an interview on the street, as a matter of fact, and kind of bragging, actually, before he became really famous. And he talked about a strategy, and this is something it's probably still done. I don't watch the markets enough to really say, but you know, it's like if you watch to see what kind of orders are flowing, the size of the orders that are flowing into the exchange towards the close. So let's say we've been in an uptrending market, and it's like retail traders who need the most confirmation, they're the most risk adverse, so they need the most confirmation that something's going to work. Okay, so to get into a trade. So this is a particular stock, for example. So they see a lot of 50 share, 100 share, 200 share orders flowing into the exchange on the close. What do they know? They know a lot of retail people are buying into the whole idea, right? So what they're going to do is, you know, they're going to see what kind of bids and offers are lining up before the close or before the open the next morning, and he would say, hey, you know what? Depending on the stock, he might have to allocate, you know, anywhere from $30 to $50 million to take out all of the bids. So let's say the market is slated to open right here. He might allocate $50 million or whatever it took to take out all the bids to drive the price down at the open. And all those, not all, but many of the people that bought on the close the previous day, this was the close the previous day, they're going to think, oh my God, what did I do? They're going to start selling, okay? Their sell orders are now going to help create this downward movement because there's an imbalance between the number of the buys and the number of sells. And as soon as they start coming into the market with their sell orders, he reverses his position and starts taking the other side of those sell orders as a buyer. So he was able to get in on this trending market, for example, at a lower price. So you just force the market lower, he gets in at a much lower price, and then the market just reverses back up again and keeps on going. This is a valid strategy that people have been using for years. I mean, this doesn't surprise anybody, does it? So it's like you got to be able to do this. You got to be able to do it. You got to be able to you know, get yourself into an emotional state of mind like a person who's playing a slot machine. It's like, how do I lose without feeling like a loser? Real simple. You're not losing. This business requires expenses. Now, you're laughing, but it's true. You think that's the way? You think the casinos, the board of directors and the management of the casinos, when you know they're looking hand by hand, they say, "Oh my God, we just lost $1,000. Oh shit, we just lost $5,000. What am I going to do here? What am I going to do?" These are expenses. The amount of money that we pay for the trade, the edges that don't work, is simply the cost of doing business to make ourselves available for the trades that do. How many people in this room have ever owned a business? When you had to buy supplies, when you had to buy pencils or office supplies, did you feel like a loser writing that check? Did it tap you into this pain? I'm such a loser? What did even? But yet you think that way now. Why? Why do you think that way? Come on, why do you think that way now? What? Yeah, but no. Why do you think that why does the potential exist for you to experience a losing trade and tap you into the pain of what it means to be what it means to lose? Why? Yeah, because you think you know what's going to happen. You think you knew what was going to happen, and that it shouldn't be happening. Because I knew, because I have an expectation. I have an expectation that is not in line with the reality of the environment that we're operating in. Yeah, you're not thinking of it as an expense. I've got X number, my edge, like I said, my edge, I've tested my edge. I have a certain expectation about what the outcome would be. In other words, over a series of trades. But I don't know what the outcome is going to be on each individual trade. And it goes as far as this. It's like, if I said, I'll give you an edge, would that imply to you that on each individual trade, there's a 70% chance of winning?
Yes.
Absolutely not. No. 100% no. There is no way to calculate. Think about this. Think about what I just said 5 minutes ago. There's no way to calculate the odds of any given individual trade working because we don't know what the intent of other traders are. If I don't know what the intent of other traders are, how in the world can I calculate the odds of any given individual trade? I can't. It's impossible. I can be ready to put on a trade where it's destined, what I mean by destined, it's destined to lose the instant I get filled. And why? Because I don't know that some big hedge fund manager is going to unload a whole half his inventory of a particular commodity or stock in the opposite direction of my order. How would I know that? That his order's coming down the pike 1 minute after I get filled. How would I know that? And if I can't know that, then how do I calculate the odds of success of that trade? I can't. That means the risk always exists. I can't even calculate the odds of success of any given individual trade. And when I do, it would, let's say, in the discretionary mode, it would be based on my experience, but in essence, I still know I'm guessing. I can say, yeah, I think this trade has a good likelihood of working out based on the pattern. But at the same time, if the pattern, whatever pattern I'm looking at, whatever's going on in the market in relationship to, let's say, news or anything else like that, I still don't know what that one individual trader might be doing or intending to do. Keep in mind that the patterns, the collective behavior patterns that give us our predictions are consistently show up over and over and over again, and they are reliable. But it only takes one trader somewhere in the world, just one trader somewhere in the world, to negate the positive outcome of that pattern. We have an expectation based on the pattern. It only takes one trader, just one, unloading a huge order within minutes or whatever after we get into our trade. That's all. Tell me how you're going to predict that. Tell me how you're going to calculate the odds of that trade working.
The average rate is by itself.
It is not a 50-50. I'm going to stop you right now. There's no way you can say it's 50-50. There's no way you can say it's 50-50. Oh, I just said that a trade could be destined to lose. There's a virtual 100% certainty that you will lose, even before you put the trade on. So how's that 50-50?
What I'm saying is that, yes, that's what you're saying is true in terms of we can't predict it, but within the context of probabilities based on our analysis, we have to make a decision based on that with the risk.
Yeah, you have to make a decision, but keep in mind these decisions. You have to expand. You have to expand your perspective. You want to make this decision on a trade by trade basis. What I'm saying is that we're going to expand our definition of success from a trade by trade basis. This is trade 1, trade 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, to what I call a sample of trades. In other words, I am not concerned with the outcome of any particular individual trade within the 20 trade sample size. What I do is trade in 20 to 25 trade sample sizes. And what I mean by that is that I'm saying to myself, I'm based on testing the particular variables that define my edge. I have found that I've got, let's say a 60-40 win-loss ratio. And we're not talking about, and how your profit in relationship to, into what your expenses. But just like, let's just keep it at a 60-40 win-loss ratio. And so I say to myself, what I'm going to do is I'm going to take the next 20 trades and find out what my results are. Now, I like trading in 20 to 25 trade sample sizes because what you want is you want your sample size to be large enough to adequately test your edge. You want it to be small enough so that if your edge starts deteriorating over time, because we're dealing with a fluid environment, edges can get better and edges can get worse. And you want to be able to stop your sample size so that if your edge is actually deteriorating, you can change the variables before you lose too much money. But you got to take this expanded view that I'm not trading trade by trade anymore. It's over a series of trades. And so if I like my outcome at the end of 20 trades and I look at what my outcome is, what my profits and losses are, if I like what I experience, I take another 20 trades. I do not, under any circumstances, change the variables within the sample size, because that would be trading randomly. I'd be adding random variables that will skew the results. But if I like the results, then I'll take another 20 trades. If I don't like the results, since I know exactly what I did and why I did it in every single trade, I can go back and look at my variables and say, you know what, if I tweak this, if I just take a little bit more risk on each one of these trades, I actually would have been in more winning trades and experienced more profit. Or I can even see that I might not have to take as much risk. Or if I just move my profit objectives a little bit further away or a little bit closer. In other words, you're trading, instead of trading randomly, you're trading systematically. Because you're going to learn what works and what doesn't. As long as you're adding random variables into your equation, you never learn what works and what doesn't. You will over a period of time. It might take you 5 years or 10 years or whatever, but you can cut that learning curve back, real quick. Just stop trading randomly.
Well, that is that your variables may not change, but all the things that you're betting on or you're investing on, those variables are changing.
That's why we trade a limited sample size. That's exactly why. You're right.
What do you do when things are going bad? You've got 12 or 20 wins. The next sample size that you're running might only have 8 20 wins now. Is that statistically significant or not?
I think so, yeah. I think that usually between 20 and 25 trades, if it isn't working, I'll change the variables. Same thing. Yeah, absolutely. Yeah. So when you expand your definition of success from trade by trade to a series of trades, then the outcome, you become detached from the outcome of each individual trade. It doesn't matter. What I'm concerned about is my end result at the end of the sample size. Because the most important part of this, once you have your variables that define your edge, the most important part of after that is being able to execute. Can I execute flawlessly? In other words, can I get into these trades exactly when my edge says to get in? Or am I going to get in late because I think, I don't really think this is what's going to work. Now, and then it starts to work, and next thing you know, I'm chasing the market. Or am I going to get in too soon because, the last time, it's like, the market didn't really come down and hit my price, and I missed out on a trade, so I'm going to get in beforehand, and it turns out not to work. It's like all these ways that we can make errors deteriorate my results. Because I know there isn't one person in the scene the possibilities of being able to execute an edge over a series of trades and not have more money. And if the only reason why you don't is because you're not executing your edge properly. Because look what happens when we're trading with fear. See, this can only be done in a carefree state of mind. I can't care about the results. It can't matter. And if it doesn't matter, then I can get in exactly when I need to get in. I can get out when I exactly need to get out based on the tested variables that define that edge. And then I can experience the true potential, profit potential that that edge has built into it. I can then experience the true profit potential.
Okay, done backtesting. Gonna take a look at the charts now. And everything is just, yeah, okay. So the signal for Euro or GU came. It's exactly what I was looking to see. That's a signal to close. Not only is it a signal to close, but it's also a signal to buy. But I'm not taking the buy in this situation. This year has made me stop liking GU so much. It was the pair that I backtested probably the most last year, and it was definitely a pair I backtested the most. And then come this year, either I'm not seeing it the same way, or it's a bit different. It's definitely more choppy. Alright guys, so appreciate everyone watching. It looks like there are no questions, no pairs that anyone wants to go over. So I'm going to go ahead and close out the call here. And if you like the video, please go ahead, hit the like button and hit subscribe if you want to keep up with future content. The reason I'm doing this, I want to track the work that I'm putting in throughout my progression, or like an over the shoulder type view. And I wanted to do this for a long time, so I'm really happy that I started to do it, and I'm happy that I'm gathering this on video. But I will catch you guys later.
For the outcome.
No.
Follow the methodology.
Right. You see, this is something, you hear what you just said? Have you not read that over and over again or heard that over and over again?
In your books.
No, not just in my books, but just even in other places, right? And yet, now it's sinking in, right? Okay. See, everyone is a certain psychological distance away from not only one, being aware of these concepts, two, understanding these concepts, three, embracing these concepts, and then actually assimilating these concepts at a core level of their identity so that they become a part of their personality. And it usually happens in stages. It doesn't have to. All of us have probably, had experiences where we made, seismic shifts in our perspective instantaneously. It can happen instantaneously. It really can. When people have an epiphany, it's just like they're a different person from one moment to the next. Changing is not a function of time, by the way. We usually think that it is because if we want to change, we're gonna usually employ some sort of technique, and technique implies doing something over a period of time or a process. It's not a function of time at all. It's a function of desire. It's simply a function of actually focus, clarity, and desire. In other words, once you're really genuinely clear about how you want to change, and that clarity is sincere and resolute, and depending on the degree of desire, the change can happen instantaneously. Unfortunately, as traders, we get the idea, once we get the idea implanted in our brain, then analysis can take away the risk. These beliefs become so entrenched and so powerful that it takes having to lose fortunes several times over and really painful experiences to finally come to the conclusion or the awareness that, this isn't working. That's the common thread that you hear everyone that's broken through that threshold tell you about. What I'm here to say is that it doesn't have to be that way. You can make these changes in your perspective at a conscious level. You can take control of this process, and you don't need pain to have to go through it, or to even prompt you to do it for that point, for that matter.
So analysis can't
No. They can't do anything with respect to the risk. No. Yeah, analysis, yes. Managing the risk is different than accepting the risk. I'm talking about accepting the risk from a psychological perspective. But yeah, we use analysis to manage, position size and how far we're going to let the market go against our position to tell us that the trade isn't working or it isn't worth spending any more money to find out. With respect to the profit objective, yes. What I'm saying is accepting the risk at a core level where it essentially doesn't. I'm not really confusing guys if I say it that way. That it doesn't matter. When you can get in and out of a trade without it resonating the slightest bit of emotional discomfort, no matter what the outcome. That's accepting the risk. You can get in and out of a trade regardless of the outcome without it resonating the slightest bit of emotional discomfort. Do you understand the distinction, the difference? People sit at a slot machine for hours and they win and they lose without it resonating the slightest bit of emotional discomfort. They're having fun. They're losing and having fun. And it's only because of their perspective. Because they don't define what they're doing as losing. They're spending money to have fun. And for the possibility that, they're going to get surprised and get money. This isn't any different. It really isn't. The order flow has the same impact on price movement as a random chip generator in a slot machine. And if anybody disagrees with that, tell me how and prove otherwise.
Mark, are you also saying by assimilating these concepts where they become core to our personality, this extends beyond our trade life?
You could, yeah. Well, when I answered somebody's question yesterday about why people didn't do the exercise, I answered that question within that context, and I was actually sorry that I did. Yes, you're right. Because what ends up happening is that once we realize we can take conscious control of what we believe and how we experience our lives in trading, what's going to stop us from doing it in other parts of our life? And it's not a matter of what's going to stop us. It's like then we don't. A lot of our excuses start to melt away, and that can be pretty scary. The way I should have answered the question yesterday was that I didn't explain it well enough in Trading in the Zone. The reason why people didn't do the exercise, I really didn't, and I didn't know that I didn't explain it well enough until I started in that same, that same material for this third book, and it's like, and then I started really breaking down my assumptions about what other people understood and how they were going to relate to this material, and then it all hit me like, well, no wonder why they're not doing it. I didn't explain it well enough. Go ahead.
If I'm understanding it correctly, there's no motivation for gain. There's no motivation for pain.
I don't know where you're getting this idea of no motivation, but you're going to have to. The words you use. See, here's the problem. I'm sorry that I interrupt you, but the problem is that the words you use are important. Okay, and it's like they imply certain concepts and principles that you're operating out of. So when you use the word motivation, it's like it implies to me that somehow or another what I'm saying is impacting your motivation to do one thing or another, and it has nothing to do. But anyway, go ahead. I'll let you finish. Go ahead.
But my motivation, right? So I'm either motivated to gain.
Why are you trading?
Because I love the journey. I love to.
And it's yeah, no. See, you say to make money, but that isn't the case with everybody. Why? It's like, see, the problem for me to answer that question is that okay. Problem for me to answer that question is that we have to go into a lot more depth. It just isn't that simple. it just, you know, it just isn't that simple for me to say it just within the context of what you asked me. And I don't want to really say anything that's, you know, okay, so we can talk later. Okay.